Hello students, in our previous lecture we are discuss a problem number 6 on conversion of single entry into double entry system. Okay, I think that you will try to solve this problem in your notebook. But here again we solve this problem here. So Sri Rajesh, who maintains his books of accounts on single entry system, supplies you the following information. So Mr. Rajesh has maintained his books of accounts under single entry. We have to convert this single entry into double entry system. So here uh, particulars 31st March 2019 and 31st March 2020, it means opening balance of assets and liabilities is given to you. So first point, sundry creditors. Okay, so sundry creditors opening balance 24,000 and opening balance 24,000 and closing balance is 34,000. So in last lecture we also discussed the effect of creditors, because here we have to find out a credit sales, credit purchase, opening capital. Okay, so the creditors will be posted in creditors account, opening closing balance, as well as opening balance sheet liability side and closing balance sheet liability side. So here we write down or note that where we transfer this item. Okay, so here sundry creditors, first effect transfer. Okay, so here one creditors account. Okay, opening closing, then second opening balance sheet liability side. Okay, so these two effects are of opening balance to that account. Okay, it means the sundry creditors opening balance is transferred to creditors account. Okay, and opening balance of creditors is transferred to opening balance sheet. Second effect, liability side. Okay, first effect, then closing balance. Okay, so here we discuss it in our previous lecture, so here it doesn't matter to write down in front of that item where we transfer these items. Okay, so only discuss the sundry creditors opening and closing. Okay, so opening balance is transferred to, so here we prepare a working note. So here creditors account, on creditors account we transfer a balance, opening balance, that is by balance brought down, amounted to rupees 24,000. Okay, then closing balance is also given to you, that is closing balance is transferred to debit side of creditors account, balance to balance carried down. Okay, amounted to rupees 34,000 here. So here the closing balance is always right on the bottom of the debit side. Okay, all the items which is related to creditors account will be posted above the balance carried down. Got it? Yes sir, got it. So here we transfer opening balance Then opening balance is also transferred to opening balance sheet. So here we also prepare a opening balance sheet. So here sundry creditors amounted to rupees 24,000. Okay, got it? Where we transfer it? So creditors is transferred to creditors account opening closing, and creditor opening is opening liability, so it is transferred to the liability side on balance sheet. Here 31st March 2019, that is 1st April 2019, it means it is opening balance sheet. Then closing balance, so opening is transferred to respective account. So here closing balance is also transferred to creditors account, only transfer to closing balance sheet liability side. So here closing balance sheet is prepared here. So here sundry creditors amounted to rupees 34,000. Okay, amounted to rupees 34,000. Then stock, opening stock, closing stock. So stock has always four effects. Okay, four effects. First effect, opening stock is transferred to the trading account debit side, as well as opening balance sheet asset side, and closing stock is transferred to trading account credit side as well as closing balance sheet asset side. So here first of all we transfer opening stock. So opening stock is 30,000. Opening stock is 30,000. So opening stock here on debit side of trading account to opening stock amounted to rupees 30,000, and opening stock is our opening assets. So opening assets transfer to opening balance sheet. Stock amounted to rupees 30,000. Okay, then closing stock. Closing stock is transferred to the trading account credit side below the sales. Okay, not above the sales. So here by closing stock amounted to rupees 28,000, and that stock is also our assets or closing assets, so here stock 28,000. Got it? Then machinery opening machinery, but here we make a star in front of machinery. It means some adjustment is given, but adjustment is always, or depreciation is always compute on closing balance of machinery. Okay, so here first of all transfer opening assets. So opening assets is transferred to opening balance sheet asset side. Okay, opening balance sheet asset side. So here opening balance sheet asset side machinery, and amounted to rupees 50,000. Okay, amounted to rupees 50,000, and closing balance of machinery is also transferred, but the amount is write down in inner column. Okay, because some adjustment is given on the machinery. So here machinery 50,000. Okay, some additional machinery was purchased on 1st January year 2020, and one adjustment is given on machinery, that is 10% depreciation. We are discuss this adjustment in our previous lecture. Okay, Again, not need to discuss this problem. Then furniture, opening asset. So opening furniture and adjustment is also given on furniture. So here opening furniture is directly transferred to opening balance sheet asset side on outer column. Furniture amounted to rupees 8,000. Got it? Then closing balance of furniture. Closing balance of furniture 8,000, but adjustment is given. So we write down the furniture's amount in inner column. Furniture amounted to rupees 8,000. Then sundry debtors. So sundry debtors have four effects, that is opening and closing, then opening assets and closing assets. So here first of all transfer to working note, that is opening and closing. So opening balance of debtor is transferred to balance brought down amounted to rupees, to balance brought down amounted to rupees 36,000, and closing balance by balance carried down amounted to rupees 43,000. Got it? So here we transfer the opening and closing balance of sundry debtors to debtors account. Now we transfer a opening debtors. Opening debtors is our asset, so opening debtors is transferred to opening balance sheet asset side. So here sundry debtors amounted to rupees 36,000. Okay, and debtors closing sundry debtors amounted to rupees 43,000. Okay, then we transfer all the opening and closing balances to respective accounts. Now we transfer a cash transactions to respective accounts. Here to balance brought down, it means opening balance of cash. So opening balance of cash is our opening asset. Opening asset is transferred to opening balance sheet asset side. So here opening balance sheet cash or opening cash balance 1,000 amounted to rupees 1,000. Okay, then cash sales is posted to the credit side of trading and profit and loss account. So cash sales is transferred to trading and profit and loss account credit side. Here by sales dash first cash sales and amounted to rupees 12,000, because we add a credit sales. Okay, so that we write down the amount of cash sales in inner column. Got it? Yes sir, got it. Then receipt from debtors, it means cash received from debtors. Okay, receipt from debtors means cash received from a debtor. So cash is comes in the business, so one effect is on the debit side of cash book, then second effect on the credit side of debtors account, that is by cash, by cash, that is here by cash into bracket received, into bracket received 1,54,200, 1,54,200. Okay, then sundry receipt is our income, and income is transferred to the credit side of profit and loss account. So here by sundry receipt amounted to rupees, sundry receipt amounted to rupees 600. Sundry receipt amounted to rupees 600. Then loan from Rajendra. Okay, so loan is our liability. Loan is a liability of Mr. Rajesh. So this liability is transferred to the closing balance sheet liability side. Okay, loan taken from Rajendra during the year means 2019-20. It means this liability is current year's liability, so this liability is transferred to closing balance sheet liability side. Loan from Rajendra, okay, amounted to rupees, loan from Rajendra amounted to rupees 20,000. Okay, then okay, so here we transfer all the receipt side to respective accounts. Now we transfer all the payment side to respective accounts. So here creditors or payment to creditors, it means one effect is on the credit side or cash book or payment side of cash book. So second effect is on debit side of creditors account. So here second account is our creditors account. So on the debit side of creditors account we post the cash paid to cash into bracket paid and amounted to rupees 74,000. 74,000. Got it? Yes sir, got it. Again, then wages, but adjustment is given on wages, so write down the amount in inner column and wages is transferred to or posted on debit side of trading account. Okay, but amount is write down on inner column. Why we write down the amount in inner column? Because here adjustment is given on wages. So here too wages amounted to rupees 22,000. 22,000. Okay, then salary is indirect expenses, and it is transferred or posted on the debit side of profit and loss account. Okay, debit side of profit and loss account. So here two salaries amounted to rupees 25,000, but adjustment is so here amount is in our problem one item is missing, that is outstanding wages, sorry, outstanding salaries amounted to rupees 1,000 and closing nil dash. Okay, so here the outstanding balance was given to you. It means opening balance of outstanding. So outstanding opening balance. So last year outstanding. Okay. So here the adjustment is also on salary. Salaries, that is outstanding wages. So here write down in inner column 25,000. Okay, write down amount in inner column, that is salary 25,000. Remember the rules that says you opening outstanding is less and closing outstanding is add. So outstanding salary on 1st April 2019, so this outstanding salary will be deducted from salary. Okay, it will be deducted from salary. Last year's salary is minus from salary and current year's salary is add in salary. So here into bracket less outstanding salary amounted to rupees 1,000 and in outer column amount is 24,000. Got it? So here one item is missing in our problem, that is outstanding salary. Okay, so outstanding salary is rupees 1,000 and opening outstanding salary is less from salary and closing outstanding salary is add in salary. So remember this rule. Okay, so here opening liability. Okay, so effect of outstanding salary is transfer to. So opening salary, outstanding salary is our liability and it is posted on the liability side opening balance sheet. So here outstanding salary amounted to rupees 1,000, amounted to rupees 1,000. Got it? Yes sir. Then office expenses, but adjustment is given on office expenses, that is the insurance premium is paid up to 30 June 2020. Okay, 30 June 2020 includes in office expenses. So office expenses is our indirect expenses, and indirect expenses is transferred to profit and loss account, debit side, office expenses, but amount is write down in inner column, that is 16,000. Okay, 16,000. Then drawing is deducted from capital, but here we cannot find a opening capital of Mr. Rajesh. Okay, so here we write down here less from capital. Okay, less from capital amounted to rupees less from C means capital, less from capital amounted to rupees 14,000. Then fixed deposit means bank balance during the year. Okay, bank balance during the year amounted to rupees 10,000. So bank balance is our assets is transferred to balance sheet, but which balance sheet? So the transaction is given during the year, so this fixed deposit is our current year's asset, so it is transferred to closing balance sheet, that is bank balance into bracket FD fixed deposit amounted to rupees 10,000, amounted to rupees 10,000. Then machinery, additional machinery was purchased on 1st January 2020. Okay, so it is add in our opening machinery. Okay, and it is write down in closing balance sheet, asset side. So here we add this machinery into bracket, add addition on 1st January 20. Okay, addition 1st January 20, that is amounted to rupees 20,000. Okay, amounted to rupees 20,000. Amounted to rupees 20,000. Amounted to rupees 20,000. Then balance carried down, it means closing balance of cash, and closing balance of cash is posted on closing balance sheet asset side. Okay, because it is our assets, or closing cash balance is our assets, and the closing balance of cash is transferred to closing balance sheet asset side. So here cash balance amounted to rupees cash balance amounted to rupees 6,800. 6,800. Okay, now we transfer all the cash account. Okay, now we make a effect of adjustment. First adjustment, discount allowed were rupees 1,800. So discount received and discount allowed. Discount allowed rupees 1,800 and discount received rupees 1,000. So first effect of discount allowed is on the debit side of debtors account. Okay, on the debit side of debtors account, that is by discount into bracket allow amounted to rupees 1,800. Okay, and second effect on the debit side of profit and loss account, because discount allowed is our expenses. So to discount allowed amounted to rupees 1,800. Then discount received. So discount allowed is, the adjustment of discount allowed is transferred to respective accounts. Now we make a adjustments on discount received to respective account. So discount received is our gain, and gain is transferred to credit side of profit and loss account. So here by discount into bracket received from creditors, received amounted to rupees 1,000. 1,000 amounted to rupees 1,000. And second effect on the debit side of creditors account. On the debit side of creditors account, here to discount into bracket received amounted to rupees 1,000. Okay, 1,000 discount is received from creditors. Then second adjustment, office expenses includes insurance premium at rupee 1,000 per annum paid up to 30th June 2020. It means to find out a prepaid insurance. So here calculate or to prepare a working note to find out a prepaid insurance premium. Okay, so here prepaid insurance premium. So here insurance is paid up to 13th June 2020 amounted to rupees 1000, amounted to rupees 1000. So here find out how much months are considered after the end of financial year. So here March, April, May, June. March, April, May, June. 31st March. It means April, May and June. 3 months prepaid insurance. So find out. So here 1000 divided by 12 multiplied by 3. Okay. So prepaid insurance for 3 months. Okay, that is, for your understanding, April to June. Okay, so here calculation 1000 divided by 12 multiplied by 3 months is equal to 250. 250 is prepaid insurance. 250 is prepaid insurance. Okay, so we calculate the prepaid insurance amounted to rupees 250. So prepaid expenses is our current assets. Okay, so make a two effects of prepaid expenses. First effect is deduct from office expenses. Why we deduct this from office expenses? Because prepaid expenses or prepaid insurance is included in office expenses. Okay, amounted to rupees 1000. Okay, so here we deduct a 250 here less prepaid insurance amounted to rupees 250. Okay, so make the total or deduct the 250 from 16,000. The amount is 15,750. Okay, this is the first effect of adjustment number second. So here we write it in bracket first effect. Second effect, here remember that prepaid insurance or prepaid expenses is our current asset. So current assets is transferred to closing balance sheet asset side. Here prepaid insurance amounted to rupees 250. Got it? Yes sir, got it. So these are the second effect, first and second effect. These are the second and first. So okay, first effect on profit and loss account, deduct from office expenses, and second effect is on asset side of closing balance sheet. Then third adjustment, outstanding wages. So this outstanding is of current year. Okay, amounted to rupees 4,000. So current year's outstanding is add in respective expenses. So here current year expenses is add in respective account. So current year's expenses, outstanding wages amounted to rupees 4,000, make the total, that is 26,000. And second effect, outstanding wages is our liability and liability is transferred to closing balance sheet. Okay, current year's liability, outstanding wages amounted to rupees 4,000, amounted to rupees 4,000. Okay, then fourth adjustment, that is depreciation. So we easily calculate a 5% depreciation on furniture. Okay, 5% depreciation on furniture. Then we make a posting of machinery, because the additional machinery was purchased on 1st January 2020. So we compute the depreciation of two machinery, that is old machinery and new machinery, which is purchased on 1st January 2020. So first of all we calculate a depreciation on furniture amounted to rupees. So depreciation is deducted from respective assets. So less 5% depreciation. So 5%, it means 400 rupees is depreciation. 400 rupees is depreciation. Okay, so here 400, then we minus this 400 from 8,000 and the amount is 7,600. Okay, so this is the first effect. Second effect, on the debit side of profit and loss account, on the debit side of profit and loss account. 2, depreciation on furniture. Here write down the amount in inner column or outer column. Okay, so directly we write down the amount in outer column, 400. Here depreciation on furniture rupees 400 inner column, and machinery depreciation will be add in furniture depreciation, and total will be write down on outer column, but no need to add the depreciation. So we write down the separate depreciation of furniture and separate depreciation of machinery. Then we compute a depreciation on furniture. So here computation of depreciation on machinery. So here 10% depreciation on old machinery amounted to rupees 50,000, and depreciation is equal to, so here 50,000 into 10%, okay, or 50,000 into 50,000 into 50,000 into 10 divided by 100. Okay, 50,000 into 10 divided by 100. We get a depreciation or amount of depreciation that is equal to 5,000. Okay, then so this is our first point of working note. Second, okay, 50,000, 10%, 5,000. Second, 10% depreciation on new machinery amounted to rupees 600, I think so. Okay, so see the problem. So here additional machinery is 20,000. Sorry, amount of additional machinery is 20,000. So here 20,000 and depreciation is for, okay, so the machinery was purchased, new machinery, 10% depreciation on new machinery purchased on first January 20, amounted to rupees 20,000. Okay, amounted to rupees 20,000. So the 10% depreciation, so 10% depreciation on 20,000 for how many months? So January, February, March, 3 months. So here 10% depreciation for 3 months. So compute the depreciation. So here 20,000 into 10 divided by 100, okay, into 3 divided by 12. Okay, so here the depreciation is 2,000 into 3 divided by 12, amounted to rupees 3 divided by 12 amounted to rupees 500. Okay, amounted to rupees 500. 2,000 divided by 3 multiplied by 12. Sorry, 2,000 divided by 12 multiplied by 3. Sorry, here we make a mistake. 12 divided by 3. Okay, so 2,000 multiplied by 12 divided by 3. So 12 divided by 3. Sorry. 20,000 multiplied by 10 divided by 100, we get a depreciation of 1 year. Okay, we need to compute a depreciation for 3 months. Okay, so 3 months is equal to 2000 divided by or multiplied by 3 divided by 12. Okay, this is right. 3 divided by 12. Okay, so depreciation or amount of depreciation is equal to 500. So the total depreciation is equal to total depreciation on machinery is equal to 5000 plus 500 is equal to 5500. So this depreciation is deducted from machinery, and second effect is on debit side of profit and loss account. So here on closing balance sheet, here we make a total that is 70,000 okay, and then we deduct a depreciation sorry less depreciation amounted to rupees 5500, and the amount of machinery is at the end, the amount of machinery is 64,500. Okay, so here depreciation is deducted from machinery is first effect, and second effect is on the debit side of profit and loss account. Got it? Yes sir, got it. Okay, then next adjustment is the goods withdrawn from business by Mr. Rajesh amounted to rupees 1000, and it is also a drawing, and drawing is deducted from capital. So we need to find out a opening capital. So here to close the opening balance sheet and find out the opening capital, that is the asset side is more, that is 30,000, 50,000, 36,000, 8,000 and 100 amounted to rupees 1,25,000. Put this total on a liability side, 1,25,000, and find out the missing figures, that is capital. So 1,25,000 and total of liability is 25,000. So 25,000 is deducted from 1,25,000. We get a rupees 1 lakh as a capital of Mr. Rajesh, into bracket balancing figure. Okay, into bracket balancing figure. Then this capital is transferred to closing balance sheet liability side. So here capital, but the amount is write down in inner column, that is 1 lakh, 1 lakh, and then we deduct less, then we deduct a drawing. So find out the drawing in cash book. So in cash book 14,000 cash is withdraw from the business, amounted to rupees 14,000. Okay, so deduct this 14,000 from capital. Here drawings 14,000, then in adjustment 1,000 goods or amount of 1,000 goods was taken by the Mr. Rajesh, so it is also deducted from capital. So here less into bracket goods, into bracket goods, into bracket goods, amounted to rupees 1,000. Then we transfer the all items and we give a effect of all adjustment. Now we close the working notes. Okay, so find out a credit sales, close the debtors account. Okay, close debtors account. So total of debtors account is 1,99,000, 1,99,000 on credit side. Put this total on debit side, 1,99,000, and find the difference, and that difference is called sales into bracket credit 1,63,000. 1,63,000 is credit sales, here to sales into bracket credit into bracket balancing figure. Okay, then this sales is add in cash sales. So here we add a credit sales in cash sales, add credit sales amounted to rupees 1 lakh, 1,63,000, and the total is 1,63,000 plus 12,000 is equal to 1,75,000. So our total sales is 1,75,000. Then we close a creditors account, so the debit side of creditors account is more, and that is 1,09,000. So put this total on credit side, 1,09,000, and find a difference. That difference is called 85,000 is difference, and that difference is called by purchases into bracket credit into bracket balancing figure. Okay, so we find a credit purchase also amounted rupees 85,000, and that credit purchase is add in cash purchase, but cash purchase is not given, so we directly record the sales on trading account below the opening stock to purchases amounted to rupees 85,000. Then we find out all the missing items. We posted all the adjustment and items to final accounts. Now we make a total of trading account, and the total of debit side, sorry, total of debit side and credit side. So the total of credit side is more, that is 1,75,000 and 28,000, and here we deduct a loss, or we cannot give a one effect of drawing. So here in our adjustment fifth, adjustment number fifth, during the year Mr. Rajesh has taken goods of rupees 1,000 for his own use. No entry is passed in the books of accounts. Okay, so we give a one effect, that is we deduct these goods from capital, but second effect is not given, and that second effect is the goes to the trading account credit side, that is by drawings and amounted to rupees, because the 1,000 goods is withdraw from 1,000. Okay, here we deduct this 1,000 from directly sales because it is a drawing, but here no need to deduct this amount from sales. Directly we post drawings on the credit side of trading account. Okay, that is 1,000. Okay, got it? Yes sir, got it. So remember this, I was forgotten the effect of drawings, second effect of drawings on trading account, but while computing or making total we remember this. So remember this, if drawing is not recorded in the books of accounts, then always two effects of drawing, first is deduct from capital and second is on the credit side of trading account. But here if the goods withdraw, if cash is withdraw, then second effect is on cash side. Okay, here goods withdraw from business for personal use, then we make a total, and total is total is 2,04,000, 2,04,000. Okay, 2,04,000. Put this total on debit side, 2,04,000, and the difference is 63,000, and that difference is called 2 GP, 2 GP carried down. This carried down is brought down in credit side of profit and loss account. GP brought down amounted to rupees 63,000. Make the total and find the net profit. So total is here total is credit side total is more, that is 64,600. Put this total on debit side 64,600 and find the difference. Sorry, we did not give a depreciation effect, so here 2 55,000, and the difference is called net profit, amounted to rupees 17,150. Okay, and that difference is called to net profit transfer to or balancing figure, transfer to capital. So here we add this profit in capital. So here net profit 17,150, and the total capital is equal to 1,02,150. Okay, then we make a total of assets and liabilities. Okay, so here 28,000, 6,800, that is 28,000, 64,500, 250, 7,600, 43,000, 10,000. Okay, then we make a total, and total is 1,60,150. So total of asset side is equal to 1,60,150. So make the total of liability side. So total of liability side is equal to the total of asset side, 1,60,150. So here our problem is tally. It means our solution is correct. That is 1,60,150. So here our solution is correct. Okay, so net profit 17,150, gross profit 63,000, net profit 17,150. Okay, so here we complete a problem number 6 as well as Here we over the unit number second or complete the unit number second, that is conversion of single entry into double entry system. In our next lecture we are start a next unit of our syllabus. Okay, thank you very much.